Been a minute since we've been together, but I'm excited to just get back on here with you guys and talk about our favorite subject and get into another training, which is the one that we call Mr. Johnny B's. He always does such a spectacular job on this one, and mainly because it's his field, it's his background. So we get into talking about a lot of stuff that he literally does day to day, or involved with day to day. So he has a deeper understanding when it comes to a lot of stuff we cover when we talk about this particular training and lesson. So let's jump into it and start off in our correct, normal fashion. Barbara, I'm gonna turn it over to you and
Yes, sir.
get us going.
So, this is lesson 2 of Futures and Commodities 101. Learning the terminology and lingo. This is part 1 of lesson 2. So, here is our disclaimer. Trading and investing carries a high level of risk. You could lose some or all of your investment. Trading commodities or any other financial instrument may not be suitable for all investors. Before deciding to trade, you should carefully consider your investment objectives, level of experience, and risk appetite. We accept no liability for any losses or damages you may incur. You alone are responsible for your actions in any trading or investing activities.
All right.
All right.
I'm thinking about it, Barbara. You want to go over that group trade we got at the end of the call?
Yes. Yes.
Okay.
You ready for the quizzes?
Yeah. I think we
Okay.
got quite a few of them.
Yes. So looks like the first quiz says which of the following are rules that we follow when it comes to trading? A. Don't follow the trend. B. Never use a stop loss. C. Have a plan. D. Have a system. E. Go to Disney World. F. All of the above. G. None of the above. H. Not sure. Which of the following are rules that we follow when it comes to trading? A. Don't follow the trend. B. Never use a stop loss. C. Have a plan. D. Have a system. E. Go to Disney World. F. All of the above. G. None of the above. H. Not sure.
Why you laughing, Barbara?
Because I was like, go to Disney World. That one of the choices.
Oh man.
Okay.
Okay, y'all, let's go. Come on now. Talk to us. What's the answer?
I'm darn
I'm
sure I'm
not.
not going to Disney World, that's for sure.
I'm not sure.
See,
Nobody got an answer?
Zuli says C and D.
I agree. Have a plan and have a system.
Paula said, have a plan and have a system. And what letters were that, Paula? You know? Was it the same that
Yeah,
Zuli said?
like Zuli said, C and D.
Okay. Yeah, well, I wanted to make sure we got into this. Some of y'all had a different answer. So come on to the front of the room. Come on. Who who
I
who,
had
who thinks
C.
something different? Yeah.
I had C.
We had some different rooms. You had C? Okay. We had some
Yeah.
different answers in the group. So y'all please unmute, tell us what you think. Anybody got something different from what Zula and Paula said? Nobody got anything different. All right. What's the correct answer, Bob? I could have sworn I seen some of y'all say Disney World, go to Disney World,
Yeah, they did. They said if you
but
have a stop
nobody's
loss,
saying nothing right now, huh?
y'all agreed you could go to Disney World if you got a stop loss in place. So that's why we put E.
So what? So so read the question, the quiz one more time, Barbara.
It says, which of the following rules that we follow, which, which of the
Say
following
that
are
say
rules
that
that,
first part again. Say that first
which of
part
the
again.
following are rules that we follow,
Stop right there. Say that part again one more time.
which of the following are rules that we follow,
One more time. That part. One more time.
which of the following are rules that we follow.
Does anybody have the rules written down or a screenshot of the 20 rules?
They're in the book.
Can anybody tell me which rule is go to Disney World? See, y'all didn't
Neither
read the quiz.
rule.
I
20. Mr.
didn't read the
Delvin's
quiz.
rule.
Technically, we're wrong.
Yeah, y'all
That's
didn't read
not
the
a rule.
quiz. Yeah, go to Disney World is not one of our rules.
Number 21.
Number 21. Oh, I love it.
It's a special rule.
Awesome. Sometimes I throw a little option in there, multiple choice in there to throw y'all off a little bit, but good one, y'all. Good one. All right, let's go, Bob. Correct answer was C and D.
Yes, sir. What is the golden rule? A, always trade with a stop loss. B, make sure you follow the rules. C, don't risk more than 10% of your account on any particular trade. D, control your emotions. E, all of the above. F, none of the above. G, not sure.
Mm. Y'all too quiet. Nobody?
Nicole
No to go.
says C.
C,
Zuli says C.
C,
Let's see.
And C, what was C?
Don't risk more than 10% of your account.
no more than 10%.
Oh, we can't risk 100%.
You could. Nah, I'm not.
I'm like, Brother Steve. I'm like, Steve, no. Mm-mm.
No, sir.
We're not doing it.
You shouldn't.
It's over my risk appetite.
I agree.
Yeah, we don't want to do that, y'all. So 10% is, as Stephen was pointing out, before we started the call, we don't like to risk more than 10%, but it doesn't have to be 10%. It could be 5, but no more than 10%, right? So awesome, y'all. Okay, what we got, Barbara?
Some groupings in the futures market trade almost 24 hours a day. A, false. B, true. C, not sure. Some groupings in the futures market trade almost 24 hours a day. A, false. B, true. C, not sure.
Let's go, y'all.
Nicole says B.
Nicole says B. What is B?
True.
True. Anybody think different from what Nicole said?
Zuli says A.
What's A? Johnny? What was A? Is A
A,
false?
A is false.
Okay. The answer is B. Some of these groupings trade almost 24 hours. Some of them close for about 30 minutes to an hour and they open right back up for the next session, for the evening session. Just depends on what grouping it is, but some of them trade almost 24 hours. Awesome.
All right. If you had some cash to put in the market, which would you choose to put your cash in? A. Nabisco. B. Dunkin'. C. Krispy Kreme. D. Sugar. E. None of the above. G. No, all of the above. G. None of the above. I. Not sure.
Okay. Come on, y'all. Talk to us. Which one would you choose?
Julie says D. Nicole says D.
So do I. D.
What's D?
Sugar. Sugar, sugar. Oh, sugar, sugar, sugar.
Anybody else put their cash in something else other than sugar? But it turns out that there was no wrong or right answer. It was just whatever you decided that you wanted to choose. I was just giving y'all something to think about. But there was no wrong or right answer. But John went deep with it.
Mm-hmm.
Sad to say, yeah, it was just basically the same question that we normally ask when we talk about the coffee or coffee shop. It was basically on the same line. I was just giving y'all something to think about. No right or wrong answer. Whatever you choose. All right.
All right, got another one. One of the commodities that traded in the futures market was banned from the market. Which commodity was banned from trading?
Onion. Onion.
Somebody was laughing. Who was that? Who laughing?
Me.
Oh, Johnny B.
Steve said onions.
Somebody said onion.
Yep.
And anybody say something different? Somebody said lettuce. I heard somebody say lettuce.
Julie said wine.
That is.
You want to answer that, John? You want me to?
Go ahead.
Well, long time ago, Julie. I forget what year it was. I want to say maybe uh, back in the 50s. I have to try to remember who the president was. But back during back in the day when there was when onions traded in the futures market, there was a gentleman who came up with an idea and a plan and tried to corner the onions market. And when he tried to corner the onions market, it it caused such a destruction in the market that the president passed the act. I just see somebody post something. Nicole, did you have an answer? I thought I saw something come up on.
I just put 1955. That's when it happened.
That's when it happened, 1955. Who was the
Mhm.
president, Nicole? Do you know?
I don't know who the president was, but when I saw the question in the group, I definitely looked it up, and it talked about how two guys manipulated the market and caused the market to be short, and so it just caused a big disruption in the market at that time. I'm not sure who the president was at that time, though.
Right. And absolutely great. Good. Thank you. And because of that, the president passed an act called the Onion Act that banned onions from being traded in the futures market. So onions used to trade in the market before this, but he banned them from trading in the market because of what happened. Awesome. Did that help, Zuli?
I looked up the president while you were talking.
Talk to me, Alice.
It was Dwight D. Eisenhower.
Okay, President Eisenhower, he banned onions from trading because of what happened. So we don't never want to try to corner the market. It's actually illegal. Anybody seen a live example of that before?
Silver.
Yes. How about a movie? Anybody seen a movie where they showed an example of somebody trying to corner the market?
Trading places. They cornered, actually, they cornered orange juice.
Yeah. Yeah.
Trading places.
But the answer I was looking for was limit up. So everybody remember Casey? Once Casey finally got confidence and became a real good, successful trader, she decided that she wanted to help the farmers make money, and she didn't no longer want to go along with the plan that Nike had her doing. So what did she do? She tried to corner soybeans, and she went to prison. Anybody remember that?
I do, I do, I do.
Yeah. So awesome. It's a good it's a good little story to look up and read like Nicole did if you really want to understand what happened. But onions was the correct answer. Was that it, Barbara? Did we had about 5 or 6 of them, didn't we? That's all of them, man.
That was it. Yes, sir.
All right, all right. Right, let's rock and roll, y'all. Great job, everybody.
All right. So, about the book.
Man, I looked that book up. It's not available anymore. Um, it's sold out. So if you didn't get a copy, it's it's sold out and no longer available. Anybody believe me?
I was
I'm
about to
just
say I got mine this week, so I was one of the lucky ones.
So was I.
I'm just kidding. I'm just kidding. I think it's available.
Some more.
Is it 14 or 15,000 distributors, Barbara? It's available. I'm just kidding, y'all.
15,000 distributors. A lot of places you can get it from.
How's the sales going, really?
They it seems like I think it get better and better every quarter. I don't know. Well, I think Barbara probably knows more than me, but I
Yeah,
think it's it.
they come in by the quarter, so it's consistent every quarter.
Do you know how
Yeah,
many you've sold?
the more it moves up
That I don't know. I
on
don't
the engine
know.
search, on the Google search, the better it does. So when people go to look up trading books or futures books, the more it keeps moving closer to those front pages, the better it'll be doing with the sales. Somebody said they got one this week. Was that Sandra?
Yes, sir.
If you don't mind, can I ask what site did you get yours on?
Amazon.
Okay, thank you. I was asking that because sometimes different sites have it on sale versus others. So always, if you're looking for the manual, kind of check around. Might catch one on having it on sale. Amazon seems like they have it on sale more than anybody. All right, leave us a leave us a review when you finish reading it. Okay,
Will do.
thank you.
All right, we want to give special thanks to the CME Group. They happen to be the largest exchange worldwide. We use a lot of their education, a lot of their videos for our Sunday night calls. Also, barchart.com, that is our go to platform. They are the leading provider of real time market data for stocks, futures, and commodities. If you have been on any of the financial channels and you see the charts going across the screen, that's barchart.com. They have a free account and they have a paid account. So you're we recommend that you open up a free account, but if you would like a paid account, they also offer that as well. All right, Mr. Johnny, it's on you.
About futures. We're going to talk about definitions tonight. When people and companies come to the futures exchange to buy and sell commodities and financial products, they're trying to remove risk from their business. What's that called? Hedging. Or make money as an investor when prices fluctuate. Derivatives like futures and options help protect their goals even if prices move the wrong direction.
Hey, Johnny, before we move from that, you mentioned that some, some people get into the futures market so that they can kind of take some of the risk that they take on in their business. If that's something that you do yourself?
Absolutely. Um, we raise cattle, and if the price goes really, 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 really up, then we can sell our calf crop um, to protect against the price going down. Okay. Um, or we can lock in a profit. So if we know we need X number of dollars uh, to make a profit, then we can lock that profit in. And then at the end of the contract, we can either buy that contract back and take the difference and then sell our crop, or we can go ahead and have it delivered through that delivery we all talk about. We can actually deliver those cattle into the market to a commercial feedlot that has bought that contract.
Awesome, awesome, awesome. I asked Johnny that question because y'all hear us talk about how, we always talking about how important this market is, just to give you an understanding or idea of how important and uh, how big this market is, and what it means to a farmer and a rancher, what it could potentially do for their business. All right,
And
Johnny.
actually, a big farmer that um, to carry this a step further, let's say I go to the bank and borrow the money for the seed to plant a whole bunch of wheat or corn. They may require me to participate in the market to protect that um, crop and that loan, for the seed to make sure that um, that we cover our price, to make sure we cover the loan. Does that make sense?
Absolutely. One of the things they do themselves is participate in the market. So yeah, it definitely makes sense.
Mhm.
Appreciate that. Go ahead.
All right. Commodity, we define a commodity as a necessity, a physical product or financial instrument approved and designated for trading or cleared in accordance to the rules of the exchange. Um, may also refer to a physical commodity, i.e., corn, crude oil, gold, etc.
Yes, yes.
Okay. Who participates in the market? A commercial trader. These are the people that actually want to take possession of or delivery of that contract. For example, an airline that comes to the market to hedge its fuel prices. So if the price is low, they may buy a bunch of contracts so that if the price goes up, they have locked in their price for the uh, jet fuel. As a result, the airline can fly more flights and serve more customers before it's able to buy into the market again. It's able to predict and manage its fuel costs.
Hey, Johnny, not to keep jumping in on you, man, but you shared an example with us on one of our retreats of this one of the airlines doing this, where you actually, read about it, right?
Oh, well, and it's happening again. Um, the last time the price of oil went really, really high, Southwest Airlines had bought a whole bunch of contracts before the price went up. And so when everybody else was losing money, they were making money because they bought their fuel cheap. Okay.
Mm.
The same thing that's happening. Spirit Airlines just went out of business, right? If they could have, and one of the reasons is because, well, one is debt, but the other was the high price of fuel. So if they could have utilized the commodity market and bought their jet fuel early, you know, they might still be in business, but they're in bankruptcy now.
Yeah. Awesome. Thank you, John.
Okay, a CTA is a trader working as part of a hedge. CTA. What in the world do you think that is? Commodity trading advisor. Sit right there. All right. CTA is a trader working as part of a hedge fund that uses the futures and options market to grow its portfolio and make money for investors. They take on risk strategy to generate profits to the end. Okay. A futures commission merchant is an industry term for a futures brokerage firm licensed to trade in the United States Futures Exchange. It can trade futures and options at a CME as well as the ICE, right? Um, for its own funds as well as on behalf of customers.
Hey, Johnny, if you don't mind, one more thing I want to jump in and say on this one. Now, when it comes to trading in the futures market, in order for you to buy and sell futures, you have to buy and sell futures through a licensed futures brokerage firm. The only legal way to do it. If you do it any other way, it's not the legal way. You have to go through a licensed futures brokerage house in order to trade, but you're able to buy and sell futures. So very important to know that. All right.
When we watched the movie Limit Up, you noticed a lot of traders on the floor. Okay. That's been replaced by the electronic market maker. The electronic market maker develops complex algorithms and computer models, enabling it to trade derivatives and display buy and sell prices to other traders, adding speed, transparency, and liquidity to the market. So in today's world, everything's pretty much done electronically. Next, an asset manager. An asset manager can come from virtually any organization. For example, a university may have someone on staff to protect the value of its endowment, helping meet investment goals and fund scholarships, facilities, and professors. The yeah, this trader, proprietary trader, is a speculator who takes positions in the market on the view of how the market will perform. This trader plays a critical role in taking both sides of the market, adding to competitive price discovery and liquidity. What does a small speculator bring to the market? That's us, folks. It adds liquidity. It makes it easier for large participants to enter and exit positions, contributes to the price discovery by placing bids and offers based on the market view, accepts the risk that commercial hedgers want to transfer, and can profit from short-term price movements in any direction, and participate individually without the capital or complexity of institutional traders. Now, that's a big statement there, folks. You know, we can sit here in our group and go, who wants to participate in this trade in the 30-year bond or 30-year treasury bill or corn? But these big institutions, a lot of that stuff has to be done by committee, and it's a lot more complex than we just make up our mind and play. Does that make sense?
Yes, it does.
And even the commercials and the producers, it's a little bit different for them as well. Okay.
If you don't mind, Johnny,
Yeah.
back to that slide we just covered with what does the speculator, small speculators bring to the market. I think it's important that we point out, even you pointed out all these different things that small speculators bring to the market, but make sure we, just point out that not only they bring all these things to the market, the small speculator is the most important out of all those different traders Johnny just went over. The small speculators considered the most important because they're the ones that really make the market work. There's more small speculators than the commercials, the producers, all the different type of traders you heard Johnny go over. The small speculators, there's more of them than any of the other group, and because of that, the small speculators contributes the most to helping the market work the way it does. Thank you, Johnny.
All right, now we want to talk about liquidity. Liquidity refers to how easy and quickly a futures or a commodity contract can be bought or sold in the market without significantly moving its price. That's a big statement there. Okay. Liquidity refers to how easy and quickly a futures or a commodity contract can be bought or sold in the market without significantly moving its price. All right. A liquid market means there are plenty of buyers and sellers at any given time. You can enter and exit a position quickly. The bid ask spread is tight. This is some small difference between what the buyer will pay and the seller will receive, uh, will give or will receive. This is something that I teach a lot in the crypto world. You've got to make sure that you know what the spread is. If not, you may pay a lot for a coin or receive a lot less for a coin, and it takes you a lot longer to either recover or to get in a profitable situation, or you end up losing when you thought you were in a gaining position. Okay. Next.
Is that the order book, Johnny?
That is the order book. And
Yeah.
commodities have order books too. You'll see what's the bid and the ask. Okay.
Awesome.
Volatility, a measurement of the change in price over a given time period. High volatility means large price swings. And you've got to learn this. High risk, but also higher reward potential. Low volatility means smaller and more stable price movement. Why do I say you've got to cover this? If you put a stop loss in too close on a volatile market, you can get stopped out before you even get a chance to make a move up. We've seen this a couple of times, haven't we, folks?
Mm.
You know, another's the volume, the number of contracts trading during a specific time frame. Usually one trading day. Every time a buyer and a seller completes a transaction, one contract of volume. It resets to zero at the start of each trading session. Think of it as the activity level of the market for the day. An open interest. These are the total number of contracts that are currently open and have not yet been settled, closed, or delivered. All right. A contract is added to the open interest when a new buyer and seller enter a trade together. It decreases when an existing holder closes their position. It does not reset daily. It carries over until the contract closes or expires. Think of it as the total money committed to the market right now for that contract period. Okay. the regulators. In the United States, the Commodities Future Trading Commission regulates the nation's futures and options market. Okay, they are responsible for protecting market participants from fraud, manipulation, and market abuse, and ensures the financial integrity of the exchange. Meaning, the commodities and futures trading is highly regulated and supervised. Okay. Before we go forward, we covered some key things here. We covered, oh, I wish I'd have written them down. We covered, let's go back to the quick. We'll just go back really over them real quick. Okay. We covered different markets, and you've heard us say it, but primarily it's the commercials, the producers, the large speculators, okay? Get going. And the small speculators, which is us, which is the most important. We covered liquidity, volatility, volume, open interest. All right. Those are the key that when you get ready to get into a trade, you want to look at prior to getting into the trade. You want one with a lot of open interest, a lot of volume, right? Volatility can be good and bad, right? Primarily, you want to be in a liquid market where you can get out of a trade once you've gotten into it. Okay? And the key factor is this is a highly regulated market through the CFTC. Or is it the CTFC? No. Commodities, Futures, and Trading. I'm playing. I'm sorry.
Man.
CFTC.
And then and to wrap it up, Johnny, if I can, just to say a couple of things like what we covered tonight. You know, we talked about the speculators, and I mentioned about they being the most important out of all those different groups. And then on top of that, why were they so important? Because of that liquidity Johnny talked about. The small speculators being more of any of the other ones, we bring that liquidity to the market. That's why when I talked about we really help to make the market work. But one of the things I just want you to know, we want you to start out right in your journey. And the proper way to get started, we feel, is to go over rules that we need to follow. And then go over the lingo and the terminology that we need to learn so that we get into something that we've never been involved in. And here's all this foreign and different type of terminology that we never heard or don't know what it means. It's important to know these things. That's why I get a headache. I go on YouTube or I go on TikTok or whatever, and I see all these videos, people telling people how to get started with trading. And the first thing they talk about is finding a platform that you're going to, trade on, and then finding a strategy. And it's so not the way to get started properly. You need to know the lingo and the terminology before you even get started. How many people that are in the market have no clue what volume and volatility means and how important it is to get in the trade, open interest? This is so important that when you get into a trade, these are things you need to consider before you get in a trade. We just went over this earlier today. We make sure we look at the volume and the open interest before we say, okay, we're going to commit to this trade, because we want to be able to have that that liquidity. We want to be able to get in and be able to get out. I say this all the time. What good is it to make $5,000 on the trade and you got no way of getting out of the trade because there's nobody to sell it to? That's where liquidity brings where we can get in and out with no problem. So I hope everybody receives value from this. And we also we want to know too, for those of you who have went through the book, who have went through the lessons and feel now you're at a part where you're ready to get started, you're ready to jump into paper trading and or maybe at a point where you're ready to live trade. I don't know where you at in your journey, but we did have a group trade that we had, put together. And I need to tell you guys, I chose the wrong contract month. So we chose the June contract month, and actually the September. It's been 2 weeks since we was on last, and the September contract actually broke out of the channel. But we got we put our order in to get into June, which is still haven't been filled. And what we did was go back over that and took another look at it. And what we're doing now is doing the same actual trade. We just moving and changing into a different contract month. Barbara, what you got for us on the screen right here?
So I pulled up the trade that we're going to do together, whether you trade it live or you paper trade. It is the 30-day Feds Fund, and let me show you how I got to this in bar chart. So I clicked on the futures button here. I double clicked it, and when I did, it brought me to the futures market overview. I click full list, and I just know that this is under the financial commodities grouping. So I click there, and it is towards the bottom, 30-day Fed Funds September. So I clicked there. And then it takes you to the futures prices page. This is all of the contract months for 30-day Fed funds. We're choosing September. We're choosing
Barbara, did we decide on August?
Yes, that's what I just corrected myself. My apologies, everyone. We chose August because it has the highest open interest. So we went with August. And it brought me to the price overview page where the contract specifications are at, what time the market opens. And then I'll go to the full chart. So here we are. You can take a screenshot, or it's in the group. It's been posted in the group so you can get the numbers.
So this is our setup.
Yes, this is our trade setup for a buy limit or a sell limit order. So depending on which direction this breaks out in, we're going to enter here with a buy limit if it breaks out here, or a sell limit below if it breaks out here. So you're going to enter 2 orders with your broker, or you're going to paper trade. You're going to have 2 initial orders. You're going to have to wait to see which direction price goes into to break out. Then the other becomes your stop loss, but you're going to have to, if you're trading it, paper trading it with a broker, you're going to have to go in and delete that opposite order that did not get filled, and you're going to have to readjust it to fit your count size to not risk more than 10% for your stop loss, because the other order becomes your stop loss. So you have to enter a manual stop or a trailing stop, whichever one you're going to enter. But that is what you're going to have to do. with this order. And
And this is
make
in the
sure it's
posted in the group,
GTC.
right, Barbara?
Make sure, yes, it's in the group. Make sure it's good to cancel. If you put it in yourself, make sure you tell the broker, if you do it yourself, a good to cancel that GTC.
Now, Barbara, if I wanted to trade, if I didn't want to do a paper trade, I want to go ahead and do a live trade. What is the margin I need to get in this trade?
So if you're going to do a live trade, the margin is $247. That's right. And then the maintenance, what you have to maintain at the end of each trading day, is $225 in your account every day at the end of the trading session. And the point value is $4,167. So you want to make sure when it triggers that you adjust your stop loss, because your point value is 4,167. So you want to make sure you stay within the no more than 10% of your account risk.
So did everybody notice when Barbara was going over this trade that she talked about the open interest and what the open interest and the volume look like? This is why we chose this particular contract month. That's kind of what we just went over tonight. And what does that mean? That open interest in the volume having the most in the August contract means that this market is the August contract is more liquid than the other contract months. Not not that those other contract months aren't liquid. This one just has the more liquidity for the fact that we have more volume and more open interest. So thank you, Johnny B. Great job as always, man. And thank you, Robert, for breaking that overview and giving us the trade setup. Let's open it up for Q&A and see if we got any questions about anything tonight's training, the group trade we're doing on the Fed fund. Does anybody understand what the Fed fund market is? Even though for a long time I didn't even know what it is. Anybody know what type of market this is?
Currency, I believe.
What was that, Stephen?
I believe it's currency, interest rate, interest on currency.
It's an interest rate market, not a currency market, but it's interest rate. That's exactly what it is. The Fed fund is an interest rate market. Basically, when the interest rates are raised or lowered or even kept the same, this is this is one of the markets that'll get affected from when the Fed raised or lower rates. So if anybody was curious or wondering, what is the 30-day Fed fund? Now you know. Good job, Stephen. Any questions or comments about tonight? Anything we went over?